Have you ever looked at a massive freight train roaring past and thought, hey, forget buying a sports car, I should totally buy the entire railroad track? It sounds like a wildly eccentric old-school board game move, but the actual economic reality of owning a private railway is one of the most lucrative, exclusive, and strategically genius business models in human history. We are talking about an elite club where you literally own the steel arteries of global trade, allowing you to collect massive tolls while the rest of the world scrambles to move goods. If you want to discover how billionaires use heavy steel to build untouchable empires and outmaneuver tech giants without breaking a sweat, smash that subscribe button right now, turn on notifications, and let's unlock the secret vault of private railway economics. The ultimate monopolistic real estate play. When you buy into a private railway, you aren't just purchasing locomotives and cargo cars. You are acquiring an irreplaceable linear real estate monopoly. Unlike a tech startup that can be disrupted by a new app overnight, you cannot replicate a century-old rail corridor. The land rights, right-of-way permissions, and physical tracks cutting directly through major industrial hubs and pristine mountain passes are completely impossible to reconstruct today. This gives the private owner an absolute geographical fortress. If a massive shipping company or manufacturing plant wants to move thousands of tons of heavy cargo through your territory, they have zero alternative options. They must pay your price, use your steel, and bow down to your terms. The magic of the operating ratio. In the tech sector, investors obsess over user growth, but in the gritty world of heavy rail economics, only one metric truly rules supreme: the operating ratio. This financial magic trick measures a railroad's efficiency by dividing its total operational expenses directly by its gross revenues. A normal, bloated business might operate at a ratio of 90%, leaving a tiny sliver of profit. However, elite private railroads like Union Pacific or Warren Buffett's BNSF routinely optimize their operating ratios down into the shocking low 60s or even 50s. This means for every dollar they pull in, nearly 40 cents is pure, unadulterated profit, an efficiency level that transforms regular industrial steel into a literal money-printing machine. The indestructible physics of freight. Why do railroads make so much money compared to long-haul trucking companies? The secret boils down to simple high school physics and rolling resistance. Steel wheels rolling smoothly on steel tracks create almost zero friction compared to rubber tires burning energy on hot asphalt. A single private freight train can pull thousands of tons of cargo using just a fraction of the fuel required by an army of semi-trucks. This incredible efficiency allows private rail owners to offer massive bulk discounts to industrial clients while keeping their own internal operating costs beautifully low. You are essentially exploiting the laws of nature to systematically hollow out your competitors' profit margins day after day. The captive customer premium. Private railways don't care about everyday passenger commuters who complain about ticket prices. They cater to captive industrial titans. If you operate a multi-billion-dollar coal mine, a massive agricultural grain elevator, or a chemical processing plant, you are physically tethered to the closest rail line. You cannot economically load 1 million bushels of wheat onto individual trucks without destroying your business model. This creates a beautifully asymmetric relationship where the customer is completely dependent on the track owner. Private railroads utilize sophisticated, algorithmic pricing structures tailored specifically to what each commodity can bear, ensuring they extract the absolute maximum amount of financial rent from every single carload. The lucrative interline per diem game. What happens when a cargo car owned by one private railroad travels across the country and crosses onto the tracks of a competing network? Welcome to the highly lucrative, automated world of per diem charges. In this hidden ecosystem, railroads charge each other hourly and mileage-based rent for using foreign equipment and tracks. If a competitor's boxcar sits idle in your switching yard for too long, their corporate treasury automatically pumps money directly into your balance sheet. This creates an intense, real-time game of logistics chess, where every major player is aggressively optimizing their network speed to avoid paying rent while maximizing the fees collected from rivals. The high-barrier capital expenditure moat. You might wonder why new billionaires don't just build their own competing rail lines to grab a slice of the pie. The answer lies in the terrifying multi-billion-dollar capital expenditure moat. Maintaining thousands of miles of heavy steel tracks, reinforcing massive bridges, and upgrading locomotive fleets requires an astronomical, ongoing mountain of cash. Private railroads typically reinvest up to 20% of their gross revenues back into their physical infrastructure every year. This massive capital barrier scares away amateur investors completely, ensuring that the existing, entrenched rail barons face absolutely zero threat of new market entrants disrupting their cozy, highly profitable status quo. The hidden power of precision, scheduled railroading. Over the past decade, a revolutionary operating philosophy called precision scheduled railroading, or PSR, completely supercharged the economics of private tracks. Instead of waiting for a train to fill up with various cargo before departing, PSR forces trains to run on strict, unchanging airline-like timetables. This ruthless focus on asset utilization means locomotives spend less time idling in yards and more time moving profitable freight. By radically streamlining operations, reducing excessive staff, and maximizing track velocity, private railway owners successfully squeezed billions of dollars of hidden efficiency out of their existing physical networks without adding a single foot of new track. Unlocking the ancillary land goldmine. The smartest private railway owners know that the land flanking their tracks is often worth just as much as the steel itself. Railways are massive, decentralized property developers. They own industrial parks, key logistics warehouses, and massive intermodal terminals where trains transfer containers directly onto trucks. By strategically leasing out this adjacent real estate to major retail giants and global shipping conglomerates, the railroad creates an entirely secondary, high-margin revenue stream. Furthermore, they can run fiber optic communication cables or utility pipelines directly beneath their private right-of-way lands, quietly taxing the global digital economy while running heavy freight trains up above. The untouchable economic indicator. Owning a private railway effectively grants you a front-row seat to the global economy. Rail volume data is so accurate that central banks and elite hedge funds monitor weekly carload reports to predict recessions before they hit the news. When consumer spending rises, container traffic spikes. When construction booms, lumber and steel shipments soar. For the private owner, this data is an incredible strategic weapon. They can adjust their corporate pricing, manage inventory, and allocate investment capital with absolute perfect foresight, staying multiple steps ahead of traditional macroeconomic cycles that routinely catch ordinary corporate executives completely off guard. The multi-generational wealth compounding engine. Ultimately, the hidden economics of private railways reveal the ultimate asset for compounding multi-generational wealth. It is a slow, steady, and incredibly resilient business that thrives during economic booms and safely survives high inflation environments due to its massive pricing power. When you own the tracks, you own a piece of foundational infrastructure that the modern world physically requires to function. The daily operations pay for the heavy upkeep, while the irreplaceable corridors continuously grow in strategic value over the centuries, proving that the old-school industrial barons had it right all along. The loudest, heaviest paths lead to the quietest wealth. Building a billion-dollar empire out of heavy steel tracks proves that the most boring, old-fashioned industries often hold the most explosive profit margins on Earth. Do you think private corporations should be allowed to own critical national logistics infrastructure? Or should railroads always be publicly controlled? Let me know your honest perspectives in the comments section down below, smash that like button if this deep dive opened your eyes, and share this video with your investment group. Make sure to subscribe to the channel and turn on the notification bell so you never miss our fun, unfiltered breakdowns of the hidden world of wealth. See you next time.